The dream of living off dividends is real. But do you know how much it actually takes to turn that dream into reality? In this video, we're going to dive into the exact amount of money you need to live off dividends in 2024 and 2025. We'll break it all down. No fluff, just facts. So you can see how much it really takes to generate enough passive income to cover your living expenses. We're not here to chase unrealistic dreams. We're talking about achievable numbers that fit your lifestyle. By the end of this video, you'll know exactly what it takes to reach financial freedom through dividends and how different investments can impact the total amount needed. So let's get started with the real numbers behind living off dividends. Chapter 1. Understanding dividends and how they work. Before we jump into the numbers, let's quickly cover what dividends are and why they matter. When you buy a stock, you're essentially buying a piece of a company. Some companies, especially well-established ones, share their profits with you in the form of dividends. These payments are usually made quarterly and can provide a steady stream of income just for holding the stock. Now, let's talk about dividend yield. This is the key to figuring out how much income you'll get. The dividend yield is simply the annual dividend payment divided by the stock price. For example, if a stock costs $100 and pays out $5 a year in dividends, that's a 5% yield. Here's why this matters. High-growth companies like Apple may have a small dividend yield because they reinvest profits to grow even more. On the other hand, companies that don't grow as fast, like Altria, may offer higher yields, meaning you get more income from your investment. But don't be fooled. Chasing the highest yield can be risky. Some companies may offer high yields because their stock price is dropping, and that's not a good sign. So it's important to find a balance between a healthy yield and a company that's stable. In the next section, we'll talk about how to calculate exactly how much you need to invest to live off dividends. Spoiler, it's all about the numbers. Chapter 2. How much do you need? The key calculation. So, how much money do you actually need to live off dividends? It all boils down to a simple formula. Annual income you want divided by dividend yield equals total investment needed. Let's break it down. Say you want to cover $60,000 a year in living expenses through dividends. If you invest in the S&P 500, which has a dividend yield of around 1.3%, you would need a whopping $4.6 million to reach that income goal. That's a big number. But you can reduce the required amount by choosing higher yield stocks or funds. For instance, if you invest in a higher yielding dividend-focused fund like the Schwab US Dividend Equity ETF or SEHD, which has a yield closer to 3.34%, the amount you'd need drops to about $1.8 million. See how that works? The higher the yield, the less you need to invest to hit your target. However, keep in mind that high yields can come with risks. Stocks with unusually high yields may be struggling or at risk of cutting their dividends. So, it's important to strike a balance between a solid yield and a company that's financially stable. Also, don't forget about taxes. If you're earning qualified dividends, they're taxed at a lower rate than regular income. In fact, if qualified dividends are your only income and you're single, you can earn up to $61,000 tax-free in 2024. By understanding this calculation and adjusting based on your dividend yield, you'll know exactly how much you need to invest to cover your expenses. Chapter 3. Examples of high-yield investment options. Now that you know how to calculate the amount you need, let's talk about the types of investment that can help you get there. Not all dividend-paying stocks are the same, so choosing the right mix is crucial. First, let's look at index funds. One of the most popular is the S&P 500, which gives you exposure to 500 of the largest U.S. companies. While it has a lower dividend yield of about 1.3%, it's a stable choice with a long history of growth. If you want something a bit more dividend-focused, the Schwab US Dividend Equity ETF, or SEHD, is a great option. This fund tracks 100 of the strongest dividend-paying stocks and has a yield of around 3.34%, which significantly reduces the amount you need to invest. But maybe you're looking for something with a higher yield. Real estate investment trusts, or REITs, like Crown Castle, CCI, offer higher yields, typically around 5.94%. REITs are required to distribute 90% of their income to shareholders, making them a popular option for dividend investors. However, they come with their own risks, mainly exposure to the real estate market, which can be volatile. For those seeking even higher yields, covered call ETFs are worth considering. Funds like QYLD offer a massive 11.49% yield. These funds generate additional income by selling call options on their holdings. While this can provide great short-term income, they limit the upside potential of the stocks in the fund, which can be an issue if the market performs well. Next, there's the idea of picking individual dividend aristocrats, companies that have increased their dividends for 25 consecutive years or more. These include big names like Procter & Gamble and Coca-Cola. While their yields are typically lower, around 2 to 3%, these companies have proven they can pay and grow their dividends through tough economic times. Finally, keep in mind the importance of diversification. Putting all your money into one stock or sector can be risky. A mix of high-yield REITs, stable dividend aristocrats, and funds like SEHD or the S&P 500 can help balance risk and return. Chapter 4. Strategies to reach dividend independence sooner. Now, let's talk about how you can speed up your journey to living off dividends. Even if you're starting small, these strategies can help you reach your goals faster. First up, reinvesting dividends. Instead of taking your dividend payments as cash, you can reinvest them back into more shares. This creates a compounding effect, where your investment grows and the dividends you earn keep increasing over time. This simple strategy can significantly boost your long-term returns. Next, focus on diversification. Relying on just one stock or sector can be risky, especially if that company or sector faces challenges. Instead, spread your investments across different industries and asset types. Consider a mix of dividend stocks, REITs, and index funds to reduce risk and create a more stable income stream. Another key strategy is finding a balance between growth and yield. While high-yield stocks can provide more immediate income, they often come with risks. On the other hand, growth stocks may pay smaller dividends now, but they tend to grow over time. Combining high-yield stocks with growth stocks or funds like the S&P 500 ensures you're not sacrificing long-term growth for short-term income. Lastly, keep an eye on tax advantages. Qualified dividends are taxed at a lower rate than regular income, so investing in U.S. companies that offer these dividends can save you a significant amount in taxes. Chapter 5. How to adjust your dividend strategy for 2024 and beyond. As we look ahead to 2024 and 25, it's important to consider how current market conditions could impact your dividend strategy. Inflation, rising interest rates, and market volatility can all play a role in how your investments perform. First, let's talk about inflation. As prices rise, your purchasing power decreases. To combat this, it's essential to invest in companies that can pass on these costs to consumers. Sectors like utilities, consumer staples, and real estate tend to fare better during inflationary periods because their services remain in demand. Next, interest rates also affect dividend-paying stocks. When interest rates rise, certain dividend stocks, especially REITs, can become less attractive compared to bonds, which may offer safer returns. So it's important to diversify and not rely solely on high-yield stocks. You should also consider adjusting your portfolio's balance between growth and dividend yield. Growth stocks may not pay high dividends now, but they tend to perform better in the long term and help offset inflation. This mix can help you stay on track even as economic conditions shift. By staying flexible and adjusting your investments based on market conditions, you can protect your portfolio and continue building towards financial freedom. If you're serious about living off dividends, it's never too early or too late to start planning. By understanding the numbers and applying these strategies, you can take control of your financial future and move closer to true passive income. Thanks for watching. If you found this video helpful, make sure to hit the like button, subscribe for more insights on financial independence, and drop a comment below with your own dividend goals. Let's keep the conversation going.